Hello, Happy New Year, and a very warm welcome to today's investment coffee break. Now, this time of year, of course, is a great opportunity to reflect on last year, but also to look ahead to this one. And in fact, this time last year, we spoke with Guy Foster, our Chief Strategist, and I'm delighted to say that he's joining us again today. Guy, this time last year, you at the beginning of 2022, I think you predicted that it was going to be a challenging and volatile year, and it was certainly that. Can we start with asking you what made you give those predictions?
Yeah, of course. And obviously, it did turn out to be a probably more of a challenging year than we'd anticipated. But I mean, the
Yeah.
reason that we felt it would be was that there were a number of headwinds that we anticipated for the market, things which make it harder for the markets to really make progress. And actually, in a sense, most of them are kind of linked. So probably the big headline everybody knows about from the year just past was the pickup in inflation. The context there is that the oil price was already rising from a very depressed level, but people were also cash rich. They had lots of money from the various programs governments had put in place to support people through lockdown. They wanted to spend that money on goods to try and replace the services that they weren't able to buy during lockdowns. Supply chains were disrupted by COVID, and central banks, of course, have got interest rates at really low levels. So, I mean, there's just a whole plethora of things here which you would
Mm.
ordinarily expect to contribute to inflation. Now, inflation causes a number of problems, but the greatest, from an investment perspective, is that it prompts policymakers to want to raise interest rates. And what that does is it creates real competition for cash from savers between deposits and different types of invested assets. So that's where it creates a headwind. And it feeds into the final foreseeable headwind at the beginning of last year. And that was that at that time, valuations were quite high.
Okay. And Guy, what exactly do you mean by valuations?
Yeah, sure. So, I mean, when we are investing, if we think about how to come up with a concept of the valuation of any investment, we've got to think about what we're trying to do when we're investing. And what we're trying to do is spend money now to get money back in the future. And we all think of it in terms of, say, rising share prices, but in general, all assets, whether it's shares or bonds or anything, they really have a sort of intrinsic value that's driven by how much you have to pay now and what money you're going to get back in the future. So that could be the interest you receive on a bond, the interest you receive in a bank account, or the dividends that you receive on shares. So the payment divided by the price is a yield. So it's very simply, it's like the interest rate you'd receive on your bank. You can get a similar interest rate if you hold a bond for a long period of time, and you can get a dividend yield, which is exactly the same concept if you hold stocks. Now, if those yields are high, if you get a lot of income for a low price, then that's what we think of as assets being cheap or attractively valued. So in short, taking the end of last year as context, lots of assets at that time had low yields, which is what we mean when we say that valuations were quite high.
Okay. And so how does inflation and interest rates factor into this equation?
Yeah, so again, at the end of last year, we knew the yields on bonds and the yields on shares were quite low. So that's the point about the valuation being high. And so the question, of course, would be, well, why did anyone own them in that context? And of course, the point is that at the time, interest rates were even lower. So these low yields that you could get on bonds and shares were still much higher than the interest you could get in bank accounts, which was, to all intents and purposes, absolutely nothing. So on that basis, valuations were high, but they were still the most attractive instruments for saving. And investors are faced with the challenge of, well, do you hold cash yielding nothing, or do you hold assets yielding considerably more than that, even though you're concerned about whether the valuation of those assets? And it obviously depends upon what's going to happen with interest rates. If interest rates don't rise by too much, of course, those valuations make perfect sense. If interest rates are going to rise, then a saver is going to want a higher yield to still favorably compare with those bank deposits. Now, the bonds, the shares, they're going to pay whatever they're going to pay. The bonds pay what they promised. The shares pay whatever the company feels it can afford. Doesn't really change with what happens with interest rates. So the only way for the yields on those assets to go up and seem attractive is if the bond and the share prices come down. And that's ultimately what happened.
Yeah. Okay. And is that what we expected to happen then?
Well, I think that expecting inflation and interest rate increases is one thing, and that's what we did expect them. But in reality, I don't think anyone who really expected quite the degree of inflation and the extent of the interest rate increases that we ended up getting. So it ended up being much more severe than certainly we'd anticipated. And for example, at the beginning of the year, the Federal Reserve, which sets US interest rates, they expected that they would be increasing them by less than 1 percentage point over the year, but they ended up actually doing it by over 4%. So that's the kind of analysis, the kind of decisions that are always really, really difficult. The Fed were wrong about what they were going to end up doing. Most investors would have been in the same kind of position, but obviously you also have these uncertain things that you had no way of predicting, like, for example, the Russian invasion of Ukraine, which, of course, was a really big contributor to inflation. So you have your expectations for the year, and then you have things changing throughout the year. And, of course, that changes your expectations and those of other people investing.
Yeah. Okay. So the $1 million question, of course, is what are your thoughts for this year?
Well, I think if we use the same kind of headlines, really, I think a lot of those headwinds, they've either lessened or they've reversed to become tailwinds. So obviously, to continue what we were talking about there, yields now are much higher than they were, meaning that stocks and bonds are cheaper. Interest rates have gone from virtually nil up to sort of the kind of 4.5% range. And inflation has started to come down in quite a lot of regions. Now that could change, but there are good reasons to believe that inflation will slow. And of course that would be helpful. I mean, it's worth remembering that when prices are low, it doesn't take much for them to rise and create a high rate of inflation. When they're high, doesn't take, all they've got to do is stay at that high level, and that actually means inflation kind of descending towards zero. So from these kind of levels, it's much harder to have high inflation, and therefore that takes a bit of pressure off the interest rate picture. Now, with that in mind, it seems likely that interest rates are going to peak in the spring or early summer. More importantly, the pace of increases will certainly slow. And the financial markets are looking forward to that. They're anticipating it. In fact, that's really been behind the rally in the final quarter of last year, which covered a range of assets, stocks and bonds. And to be as clear as possible, I think there are still reasons for caution. Most obviously, the risk or indeed the likelihood that recession is looming. Now, to put that in context, the UK is probably in recession at the moment, but it won't worry the financial markets that much because the UK is relatively small. What would be much more impactful is if the US was to slip into recession. Recessions are usually associated with poor stock returns. And the reassuring thing is that part of that valuation reduction that we talked about earlier is what happens in a recession. So we've sort of suffered a lot of that already, which means there should be much less downside in shares under a recessionary scenario. And there's also some upside for bonds. So rather than this year where everything seemed to go down together, last year, in 2023, you should have more distinction with different assets kind of offsetting each other more effectively. And if we did have a recession, that would normally mark the beginning of a sustainable bull market. So that's the positive, the silver lining that comes out of obviously what tends to be quite a difficult situation. But with inflation falling, with it real incomes rising, by real incomes we mean the wages are rising faster than inflation in a lot of economies now. And the return of demand from China, that's reopened its economy following its COVID zero policy. These factors actually mean that this recession, or this kind of global recession that people have been anticipating, actually could still be some way off. So hopefully you'll remember how positive we were in the depths of the first lockdown, when markets had declined very sharply. And at that time, interest rates were being cut aggressively. I would say that sadly, this environment is not that good. It's not as good as that time. But what we can say is that investing at these levels, at these kind of valuations, would typically generate high single-digit returns from stocks over a sort of multi-year time frame. Government bond yields are around 3.5 to 4, where they had just been about less than 0.5% at times in 2021 or towards the end of 2021. And bonds issued by really solid companies, so companies that are definitely going to be maintaining their payments, they pay returns or yields of 5% or more. So these are much better returns to be investing into.
Yeah. Okay. And other than stocks and bonds, what else is there to invest in?
Yeah, I mean, most assets will have some sort of relationship with either the returns from stocks or the returns from bonds. But I mean, we do have some particularly flexible funds which can take advantage of those changes, those ebbs and flows in markets. So that's another approach to sort of diversifying. There are lower quality bonds. So I talked about high quality bonds, but lower quality bonds will deliver much higher returns of around 9%, something like that at current valuations. But you just got to understand there's a bit more risk involved with those. So we have to be a bit, more careful about which ones we buy. And another interesting area that we can invest in is infrastructure, which again is a sort of hybrid. It has some equity-like and some bond-like characteristics, but a lot of the assets are backed by governments, so they're very high quality. The yields can be around 5%, and a lot of the portfolio is protected. Its income is linked to inflation, and that's what traditional bonds tend to lack. So that's another way of getting good returns in portfolios.
Okay, thank you, Guy. So your thoughts in summary for 2023?
Well, look, I think there are a few other reasons I did want to just talk about, the historical patterns that we've seen in the past, which again can give a bit of reassurance as well. So it is, for example, it's very unusual to have back-to-back negative years, as in taking the US equity market, for example, which is the biggest. It's only happened about 3 times in the last century. So a bad year normally comes before a better year. We're also in the third year of a presidential cycle. It's difficult really to see why this holds so effectively, but generally that third year has tended to be positive 23 out of 27 times for what it's worth. But while we're not in the kind of really attractive environment where the economy is sort of bombing out, but has great potential to rebound and interest rates are being cut to support it, where we are now is in an environment where the economy is holding up okay. Interest rates have done most of their rising already, and inflation is ebbing, and stocks are cheap enough to make good returns if you hold them for a few years. So that's, I think, really how I would summarize the investing environment in 2023.
Brilliant. Okay, thank you, Guy. That was really interesting. And thank you for joining us. We hope you found that useful. And please do keep your thoughts and your feedback coming. We do like to cover as much as we can in these investment coffee break videos. We very much hope you can join us for the next one.